The following program is an original MCM production for Community Channel 14.
The following program is one of a series of programs on money and investing presented by the Milwaukee Public Library. This program is made possible by a grant from the FINRA Investor Education Foundation through Smart Investing at Your Library, a partnership with the American Library Association. Your library is a good source for safe and reliable investment information.
Hi, my name is Anna Walls, and I'm a librarian for the Milwaukee Public Library. I work in the Business and Technology Department, and I'm here today to introduce you to a special guest. We are going to do a program about investing in your 50s and your 60s. Our guest today is Ignatius Smedic, and I'm going to call him Iggy for short, because he said I could. And Iggy is the President and Chief Investment Officer for Architor Capital Management Group. He's also a chartered financial analyst. So welcome to the show, Iggy.
Well, it's great to be here.
Now, right away, I just want to ask you what a chartered financial analyst is.
Well, the Chartered Financial Analyst Institute is a worldwide not-for-profit organization that is really designed to ensure high ethical standards as well as educational opportunities for the financial analyst profession. So the CFA Institute administers the CFA designation, which is done after rigorous testing and other continuing education requirements. So the designation CFA has really become a worldwide designation for the financial analyst community as really achieving a certain level of knowledge, ethical, and continuing education requirements on a continuing basis.
Okay, that sounds great.
Yeah.
Now, as we all know, these are difficult times for investors of all ages. It's been kind of rough. And speaking, from something that's near and dear to my heart, the times can be especially difficult as people are getting into their 50s and 60s, maybe been working for 20, 30 years, and they've maybe seen their investments go down a bit or a lot. And maybe they're eyeing retirement in the not-too-distant future. So I know no one can look in the crystal ball and tell the future, but if you could give me some of your thoughts on how long you think it might take for folks in this situation to kind of recover to some extent.
Yeah, that's a tough question. I always use history as an example of when people ask me the question, what is typical or what should we expect? What we've experienced over the last year or 2 years has been anything but typical. And other times we've had bear markets where stocks have fallen and the economy has gone into recession. There's different reasons for those types of things. This particular recession, this particular bear market is very different as well as any other time in history. With that all said, the history of the financial markets in the U.S. over the last 80 years, the typical bear market lasts about 14 to 18 months, and the typical decline is about 35 or 40% in the stock market. Mm-hmm. Well, right now, in June of 2009, it's about a 17-month decline, as well as about a 55% from the highest point in the market to the lowest point, which was in March of 2009. So the duration is pretty typical versus other bear markets we've seen over the last 80 years. The magnitude of the decline is much more significant in that short period of time. So does that mean the market's going to recover right away? No, but what it does is give you some parameters of what is unique about this current situation. So to answer your question specifically is saying we've had a pretty good hit already, and history has shown that the markets react, the economy reacts, and there is a recovery period. Now, how strong and how quickly that'll happen, it varies. From our opinion at this point, we think that a significant amount of the the pain has been realized already. Again, not making the statement that the stock market will recover and the economy will recover on a dime, but I think we are seeing some improvement in the credit markets. We're seeing some improvement in the financial markets as well as the economy. So in due time, we do expect a nice recovery.
Right. So although it's painful and it's a little scary, but it's not unprecedented, and as you say, we can look at history and feel somewhat reassured.
Exactly it. And maybe some of the effects or the reactions in the economy are somewhat unprecedented, but that was said in the recession of 2000, that was said in the recession of the early 90s, and going back in history, you can look at there's always different circumstances, but there's also similarities. And based upon that, we really anticipate a full recovery in the economy and the market. But it will take time. Okay.
Also speaking about people in their 50s and 60s who are thinking about retiring, maybe they didn't do all the saving they kind of wish they had done in their 20s, 30s, and 40s. Are there any strategies that someone, say, in my boat, I'll use myself as an example, could want to approach just to start to get on better track for retirement?
Well, I think when you're in a bear market, I think that people look at their investment portfolio and saying, what I have lost. There's this theory of saying, I had this level and then the stock market falls and I lose value, so I have to do something differently. And from my standpoint, I think there's always a good strategy that saving money versus spending money is better. And so from our standpoint, we always recommend to our clients, we recommend to people that ask that type of a question is, if you're concerned about the future, saving is better than spending. So, and I think that's what's happening with our current economy is as people have become more uncertain to the future, there's been a higher savings rate, which is excellent, which is a good reaction, which is part of the mechanisms to sort of stabilize the economy, so to speak. The other concern I have is that we get the question of, should I invest differently to catch up? And one of my concerns on that is it generally is saying doing something different with regards to taking on risk or being more aggressive, maybe at a time when you shouldn't be. So from our standpoint, we really recommend to our clients that the concept of catching up what was lost could be a mistake, because you're more or less contemplating taking on more risk to achieve a higher return. And what we would rather see is maybe a higher savings rate rather than saying, let's take on more risk to try to make up the shortfall that the market created.